Listen carefully, because what I am about to tell you is not theory, not prediction, and not something you will hear repeated on financial television. If you were asleep while this happened, you missed a defining moment. A moment that quietly rewrote the rules of the silver market without asking for permission. While most Americans were sleeping, while phones were charging and markets were closed, silver crossed into territory that was never supposed to exist outside of fantasy. Triple digits, $100, not in a headline, not in a press release, in real transactions. And the most dangerous part is how calm everything looks right now. Before we go any further, take a moment and leave a comment telling me where you are watching from, city, state, or country. I read them all. Now let us start. What happened overnight was not an accident. It was not a glitch. It was not one trader pushing a button too hard. It was the result of pressure that has been building for years, finally finding an exit. Silver did not explode upward. It slipped through a crack that no one in the Western pricing system wanted to admit existed. The price most people see on their screens is not the price of silver. It is the price of a promise. It is the price of a paper agreement that assumes delivery will never be requested. That assumption worked for decades because most participants treated silver like a financial abstraction, a ticker symbol, a line on a chart. But overnight, that abstraction failed. In Eastern markets, buyers paid over $100 per ounce for physical silver. That is not a future. That is not an option. That is metal changing hands, bars being allocated, ownership being transferred. When that happens, the market speaks clearly. Someone needed silver badly enough to ignore the paper price entirely. At the same moment, Western markets were silent. The numbers on New York and London screens did not reflect what was happening in the physical world. And that is the key point. We no longer have one global silver market. We have two. One that deals in settlement numbers and one that deals in metal. I want to be clear about something. This is not hype. This is not excitement. This is not bullish cheerleading. This is structural stress. When the same asset trades at meaningfully different prices in different regions, the market is telling you something is wrong. Silver is supposed to be arbitraged efficiently. That is the foundation of modern commodities pricing. Any meaningful gap is supposed to close quickly. But that mechanism only works when physical supply is abundant and confidence is intact. Overnight proved that confidence is cracking. Western financial media will downplay this. They will use careful language. They will call it a localized premium. They will say it will normalize. They will tell you not to worry. That response is predictable because acknowledging the alternative creates panic. The alternative is simple and uncomfortable. Physical silver is more valuable than paper silver, and markets are starting to price that reality in. I have watched this market long enough to recognize the pattern. First comes denial, then comes minimization, then comes explanation, and only after that comes acceptance. By the time acceptance arrives, the easy positioning is gone. This is why the timing matters. These events do not happen during market hours. They happen when attention is low. They happen while people sleep. They happen quietly so that the system has time to react before the public does. Now, this is where gold enters the picture. Gold did not explode overnight. Gold remained steady, controlled, disciplined. That matters. Gold is the anchor of the precious metals complex. Silver is the leverage. When silver outruns gold aggressively, it signals stress in pricing mechanisms. Overnight, silver did exactly that. It moved multiples faster than gold. That is not normal. That is not healthy. That is not random. That is a signal that something beneath the surface has shifted. As long as gold holds its structure, silver has room to adjust upward. If gold were collapsing, this move would fail quickly. But gold is not collapsing. Central banks are still buying. Confidence in fiat systems is not improving. That backdrop supports the entire thesis. What you witnessed was not a top. It was not the end. It was the beginning of recognition. Recognition that the physical market is asserting itself after years of suppression and neglect. History rarely announces itself, it whispers, and it did exactly that overnight. To understand why what happened overnight is so dangerous for the existing system, you need to understand how pricing is supposed to work versus how it actually works when physical stress enters the picture. On paper, silver is one of the most liquid commodities in the world. Contracts trade constantly. Volume looks deep, spreads look tight. Everything appears orderly, but that order only exists as long as most participants agree to never ask for the metal. The entire Western pricing structure is built on that agreement. Futures contracts are created in quantities that exceed available physical supply many times over. This is not a secret. It is how leverage works. It functions smoothly as long as demand stays financial rather than physical. But the moment delivery becomes the priority, leverage turns into fragility. Overnight, delivery became the priority. The reason is arbitrage. Not the sanitized definition you hear in finance textbooks, but real arbitrage driven by physical incentives. When silver trades at one price in New York and a materially higher price in the East, capital immediately moves to exploit that difference. But unlike stocks or currencies, Silver has weight. It takes space. It must be stored, insured, shipped, and delivered. That process is slow, and that slowness creates pressure. Every ounce that leaves a Western vault to satisfy Eastern demand reduces the pool available for future delivery. That makes the next delivery harder. That increases risk. That forces repricing. This is why arbitrage is so powerful. It does not care about opinions. It does not care about narratives. It does not care about analysts on television. It only cares about profit. And right now, the profit signal is flashing bright. If you can buy silver at a lower price in one market and sell it at a higher price in another market, that opportunity will be exploited until it disappears. It does not disappear because people stop wanting money. It disappears because the price equalizes or the supply runs out. There is no third outcome. This is where the Western exchanges face a dilemma. If they allow prices to rise freely, confidence in the paper system erodes. Participants begin to question why they ever accepted settlement promises instead of metal. But if they suppress prices, metal leaves the system quietly through delivery requests. Either way, control weakens. Now bring gold back into the picture. Gold is behaving differently. Gold is not spiking wildly. It is moving steadily within a defined range. That tells you something important. Gold is being accumulated methodically. It is being treated as a reserve asset. Silver, on the other hand, is being treated as a release valve. When silver begins to outperform gold by a wide margin, the gold-to-silver ratio compresses. That compression is not just a number. It is a signal that silver is reclaiming monetary relevance. Historically, these phases are short and violent. The reason is simple. Silver is a much smaller market than gold. It does not take much capital to move it. When even a modest amount of institutional or sovereign demand shifts toward silver, price reactions become extreme. That is what creates parabolic phases. But parabolic phases do not begin with headlines. They begin with stress, with quiet dislocations, with overnight events that most people miss. This is also why media reaction matters. When something truly destabilizing happens, coverage is delayed. The goal is to prevent feedback loops, because if too many participants attempt to convert paper claims into physical delivery at the same time, the system seizes. You will hear explanations soon. You will hear reasons why this does not matter. You will hear confident voices telling you the market is functioning normally. That is how normalization works. It reassures just enough people to slow reaction time, but metal does not wait for reassurance. Another factor you need to understand is industrial demand. Critics argue that high silver prices destroy demand. In theory, that sounds reasonable. In reality, it is misleading. Industrial demand for silver is not discretionary in the short term. Manufacturers cannot simply redesign products overnight. Contracts exist, production lines exist, substitution takes time. That means demand does not vanish when prices rise. It shifts who absorbs the pain. End users pay more. Margins compress. But silver continues to be consumed. At the same time, investment demand increases. Not because people suddenly love silver, but because instability attracts capital-seeking protection. That creates a feedback loop. Rising prices draw attention. Attention draws capital. Capital tightens supply. Tight supply raises prices. Now consider inventory. Western vault inventories have been trending lower for years. That trend accelerated recently. Delivery requests increased. Registered supply declined. These are not opinions. These are reported numbers. They tell you stress was already present before the overnight event. The $100 print did not create the problem. It revealed it. This is why the phrase structural reset matters. A reset is not a rally. A rally retraces. A reset establishes a new reference point. It forces participants to reprice risk. Gold is the confirmation mechanism. As long as gold holds its structure, silver repricing remains viable. If gold were to collapse, this move would fail quickly. That is why gold must be watched daily. You are not watching silver alone. You are watching a relationship. The next phase is recognition. Recognition by institutions, recognition by funds, recognition by the media. That phase is chaotic. Volatility increases. Narratives shift daily. Weak hands exit. Strong hands accumulate. This is where preparation matters more than prediction. What happened overnight was the market reminding everyone that physical reality always wins eventually. Paper can delay it. It cannot stop it. What happens next is where most people make their biggest mistake. They assume markets move in straight lines. They assume that once a threshold like $100 is touched, the path forward is obvious. Up or down, boom or bust. Reality is more uncomfortable than that. The next phase is instability, not clarity. After an overnight event like this, the market enters a digestion period. Price does not simply continue exploding without resistance. It pauses, pulls back, tests confidence, and shakes participants loose. This is not weakness. It is structure forming under stress. The reason volatility increases is because control fragments. Different players react at different speeds. Retail reacts emotionally. Funds react tactically. Institutions react strategically. Sovereigns react quietly. Each layer creates its own pressure, and those pressures collide on the price chart. You will see sudden drops that feel violent. They will be explained as profit-taking, algorithmic rebalancing, or technical resistance. Those explanations will not be entirely false, but they will not be the real story. The real story is that paper leverage is being forced to adjust to physical constraints. Margin is the first battlefield. When silver moves this fast, margin requirements rise. That forces leverage participants to either add capital or reduce exposure. Some will be forced sellers, others will be forced buyers if they are short. That clash creates whipsaw price action that confuses anyone who does not understand positioning. Short positions matter here. Silver has historically been one of the most heavily shorted commodities in the financial system. Those shorts exist because the paper market allowed it. It assumed that delivery pressure would remain manageable. Overnight, that assumption cracked. Not every short is reckless. Some are hedges, some are arbitrage. But when price accelerates and physical availability tightens simultaneously, distinctions blur. Risk managers do not debate philosophy. They cut exposure. This is why forced buying can occur even during pullbacks. Shorts use dips to exit. That puts a floor under the market that did not exist before. Gold's role becomes even more important in this phase. Gold is not just a companion asset, it is the credibility anchor. If gold begins to trend upward with quiet strength while silver remains volatile, it signals that the move is not speculative froth alone. It signals capital rotation into monetary metals. Watch central bank behavior. They do not chase silver headlines. They accumulate gold during periods of uncertainty. If gold remains bid while silver experiences turbulence, it confirms that the system itself is under reevaluation. Another element entering now is currency pressure. Silver does not rise in isolation. It rises against something. That something is purchasing power. When metals move violently, it often reflects stress elsewhere that is not yet visible on equity screens. Foreign exchange markets are particularly sensitive. If confidence in reserve currencies weakens even marginally, capital seeks neutral stores of value. Gold absorbs that first, silver amplifies it. You will hear dismissals, claims that silver is too volatile to matter, that it is an industrial metal, not a monetary one. Those arguments surface precisely when silver threatens the existing hierarchy. Historically, silver reasserts its relevance during periods of monetary transition, not stability. The $100 moment is not about the number, it is about the psychological break. It tells the market that prior assumptions no longer apply. Once that happens, old models lose predictive power. Liquidity also changes character. During calm markets, liquidity feels abundant. During stress, liquidity becomes selective. Bids vanish at certain levels. Spreads widen unexpectedly. Execution quality deteriorates. These are early warning signs. You may notice trading halts, rule adjustments, or temporary measures framed as safeguards. They will be presented as routine. They are not. They are attempts to slow feedback loops. This is where narrative management intensifies. Media focus will shift to side stories. Broader economic optimism will be emphasized. Attention will be diverted. That is standard procedure during periods of systemic adjustment. Meanwhile, physical premiums tell the truth. When futures prices fluctuate wildly but physical premiums remain elevated, it indicates that the real market is not relieved by paper volatility. It indicates tightness beneath the surface. Another key point is time. Structural moves do not resolve in days. They unfold over months. The most dangerous assumption is that missing the first move means missing the opportunity. That mindset leads to emotional decisions. The market's goal in this phase is to exhaust participants, emotionally and financially. It wants you uncertain. It wants you reactive. That is how weak positioning is transferred to strong hands. Gold will eventually make its move more obvious. It always does later than expected. When it does, silver volatility will begin to make sense in retrospect. Until then, confusion dominates. What you are witnessing is not a spike. It is a negotiation between reality and representation, between metal and paper, between promises and possession. The overnight event was the opening statement. The argument is far from over. At this stage, the conversation quietly shifts from price to trust. Not openly, not all at once, but unmistakably. Markets always pretend to be about numbers, yet every major revaluation in history has been driven by confidence breaking somewhere deep in the system. Silver crossing $100 did not create that fracture, it revealed it. The endgame mechanics do not announce themselves with sirens. They surface through policy language, procedural changes, and subtle adjustments that most people overlook. The rules begin to bend before they break. One of the first signals is settlement behavior. When delivery timelines stretch, when alternative settlement options are quietly encouraged, when cash equivalents are framed as equal substitutes, it tells you pressure exists where transparency used to be. These are not signs of abundance, they are signs of strain management. Another signal is narrative recalibration. Analysts begin redefining what matters. They will argue that spot prices are misleading, that futures are misunderstood, that volatility invalidates conclusions. The goal is not clarity, the goal is containment. If people doubt their own interpretation, they defer action. Meanwhile, behind closed doors, inventory audits become more frequent. Risk committees meet more often. Stress scenarios that were once theoretical are suddenly modeled with urgency. None of this appears on the evening news. This is where gold's behavior becomes decisive. If gold continues to grind higher without spectacle, it confirms that the move is being accepted, not fought. Gold does not spike when panic dominates. It rises when capital makes long-term decisions quietly. Silver, by contrast, remains the pressure valve. It reflects urgency, imbalance, and leverage. Its volatility is not a flaw. It is a diagnostic tool. When silver stabilizes at higher levels after violent swings, it indicates that forced adjustments have largely occurred. You may notice that volatility eventually compresses, not expands. That compression is not bearish. It is consolidation of a new regime. The market is learning to operate under different assumptions. Another overlooked factor is political sensitivity. Metals do not exist in a vacuum. Rising precious metals challenge narratives of stability, control, and effective policy. As a result, official commentary becomes more confident, not less. Reassurances multiply, confidence is declared, not demonstrated. At the same time, regulatory language becomes more flexible. Emergency powers are framed as preparedness. Temporary measures acquire vague timelines. The system buys time. What matters is not whether silver holds $100 exactly. What matters is whether the system can return to the prior equilibrium. History suggests that once a monetary metal reprices decisively, it rarely returns to the old narrative. People often ask what the trigger was. They search for a single event. That is a mistake. Transitions are cumulative. Years of leverage, promises, and distortions do not unwind neatly. They reach a saturation point, then release pressure asymmetrically. For individuals watching from the outside, the temptation is to seek certainty, clear signals, absolute confirmation. That desire is understandable and dangerous. Markets do not offer certainty at turning points. They offer probability shifts. The most telling sign that the endgame is progressing is behavioral change. When participants stop asking whether something will happen and start asking how to adapt if it does, the transition is already underway. You will see this in language. Discussions shift from predictions to contingencies, from timing to exposure, from price targets to risk tolerance. That psychological pivot precedes structural change. Liquidity providers also adjust. They become selective, defensive, and cautious. They demand wider spreads and stricter terms. That friction slows activity and reinforces volatility, even as underlying demand remains strong. Physical holders behave differently too. When price rises but selling does not increase proportionally, it signals conviction. People are not responding to price alone, they are responding to context. At this point, dismissals lose power. Arguments that once ended debates begin to sound hollow. Appeals to historical norms fail when the present no longer resembles the past. The endgame is not collapse in the cinematic sense, it is realignment, a recalibration of trust, value, and credibility. It unfolds unevenly, frustrating those who want resolution and rewarding those who understand process. Gold will eventually confirm what silver implied. When it does, the conversation will change permanently. What was once unthinkable becomes discussable. What was once fringe becomes mainstream. The overnight moment was not the climax. It was the door opening. Everything after is negotiation. The system is still speaking. The question is, who is listening?